Welcome back onto a conversation with George Thomas from Quantum AMC now. George, good morning. Thank you for joining in. I was reading about your fact sheet and you mentioned that in your small cap fund, you have increased your positions in the auto ancillary stocks and also initiated fresh positions in an auto ancillary company. Now, what's your take on this entire space? It's assumed that you're bullish on the space, but if you could tell us your rationale behind this move.
Hi, good morning. Thanks for having me on the show. Generally, from an overall market perspective, our sense is going forward, the earnings expectations are not very high. So, coming the base has kind of reset to a very low base, and then again, going to the tailwinds which we are seeing in terms of the moderating inflation and the rate cuts coming in, and even the monsoon expected to be in a reasonably good monsoon. Our sense is, earnings growth is likely to improve from here on. And therefore, on an overall level, when we look at our portfolio upside, though it is slightly lower than what we have seen in terms of, historic long-term average, but it still looks reasonably good in terms of, making into fresh allocations.
George, the other bit that you mentioned is that you have exited an FMCG stock, but the others you've also added your weights to existing positions in the FMCG space. So, in terms of the entire space, right, you divide that into staples, durables. Where does your preference lie? You would go for staples, which have been struggling for a while now, or would you go for the consumer durable companies?
See, in quantum value fund, historically for a very long time, we have not had any exposure to staples. A lot of those valuation expansion in this bucket happened between 2017 to 20, when growth was absent in the broader markets and very few names like the FMCG or the staple names kind of reported the earnings growth. And that was a period context when the market kind of, valued them to quite irrational levels. But over the last few quarters, what is visible is very clear. One, the defensive nature of the sector itself was kind of questioned, and again, there has been a lot of competition in the space from private labels and things. So even at these levels, the kind of valuations where they trade at, does not look very, enticing for us to, make fresh additions. We have exposure to a consumer durable company, which is mostly into, fans, lightings, and some of the kitchen appliances, where we feel, there is a lot of room in terms of, improving penetration and considering the levels at which it is currently trading, we feel, there is reasonably good upside to that.
George, what are the other sectors that you are putting your money to work as of now? What are you recommending your clients, and are there sectors that you are recommending to avoid, more importantly?
See, when we look at our portfolio action over the last recent months, the addition has been to a health insurance company, which has been seeing some bit of increase in their claims ratio. And our sense is the company has taken steps in terms of pricing action and to has taken some bit of pricing action and ensured that, how claims can be, well validated and stuff like that, or even educating their customer base in terms of, what are the allowable limits and stuff like that. So we are hopeful that the increase in claims ratio is kind of transient, and therefore we have made an allocation there. And the other addition has been to a pharma name, where the company had seen some bit of bumper profits from a single drug, and they have reinvested those gains into other segments where we are hopeful could lead to reasonable earnings compounding over the years. But the market is worried about a cliff from one of the drug which could go, off patent. But we are hopeful that the kind of investments which the company has done should give them a reasonable earnings compounding over the long term. So these are a couple of major additions, but of course, other than that, we have added weight into a large cap IT company when the valuations were slightly more benign, and the sector was going through peak pessimism, and when we looked at what was the kind of earnings expectation which was baked into these companies, it looked quite conservative, and we saw a potential for earnings growth to be higher than the street's estimates. And these were some of the few additions which we did. In terms of trims, so some of the pockets where the earnings growth has been fairly strong, we have made certain reductions where valuations were at full, and a couple of them were a two-wheeler premium player where volume numbers are still fairly strong, and where we felt the valuations had kind of fully priced in the underlying fundamentals. And a NPFC player who is into CV refinancing in the secondary CV market, where we felt the valuations had kind of fully priced in the robust growth and a reasonable outlook in the next couple of years.
Mm. George, very quickly, if you could tell us what's your positioning on the defense theme, because the stocks have run up quite a bit over the last couple of weeks, and from almost being down 30-60% from their top, they are now almost back to their record high levels. What's your call on defense?
See, like you said, many of the stocks had seen sharp correction, but the point to note is it's very unlikely that defense spends can grow at a rate which can justify those valuations which existed prior to those corrections. And our sense is, so of course, over the recent times we saw some flare up in terms of wars and escalations, but our sense is it's very unlikely that. These companies could compound at very high growth rates, even high double digits or high double digits looks quite unlikely for long periods of time, which is required to justify these valuations.
All right, George, thank you so much for sparing time and joining us today with your views on the various sectors. George Thomas there, or Quantum AMC. By the way, Muthoot